Hey everybody, Eric Sandstrom from the Home Loan Heroes and Senior Loan Officer with PrimeLending. Today we're going to be talking about something very important that has released from Fannie Mae. Fannie Mae is going to start allowing 5% down on multifamily purchases from a much larger down payment requirement of 15 to 25%. Those guidelines are going to be releasing here November 18th, and we're going to be explaining all that within this video. So please stand by for more information. All right, so now we know there's been a huge problem in this nation with affordability and the way that the interest rates are currently. We're starting to see interest rates above 8%, which has made mortgage payments literally more than double. So with this new update, 5% down to get into a multi-unit, there's different ways that make your payment more affordable. With a two to four unit, you can have the other units that you're not occupying help pay for your mortgage. So a lot of first-time home buyers are using this as a house hacking method, and honestly, it's a great way to start establishing your real estate portfolio. All right, so let's go over some of the updated guidelines. I'm going to bring them up on the screen here so you can see exactly what we're talking about and what the differences are as of November 18th versus what they are now. So if you look at this chart here, you see that the new down payment is 5% for all 2 to 4 units. If you look at the previous rules prior to November 18th, for a 2-unit property, the minimum down payment is 15%. So 15% still would have, for example, mortgage insurance. And anything above a 2-unit, you're going to see here that it's going to require 25% down. You literally have to put a quarter of the value or purchase price of the home down in order to qualify for a multi-unit 3 to 4 unit home. So that's huge, quite a big difference. Now let's talk a little bit about the loan limits. So as you can see, I'm going to bring up the map here. Most of the country is gray, and then there's different pockets where you'll see orange, yellow. Those different pockets have different loan limits. So if you do live in, let's say, California, those loan limits are going to apply. This program does not work for high balance loan limits. Of course, that's a key factor. So what we're going to be talking about today is the nationwide loan limits, not necessarily the rare pockets that do have a higher, limit in the area. Okay, so if we're looking at the gray area here, for a 2-unit property, the max loan is $929,850, which would be a purchase price of $979,000. So anything less than $979,000, you can do with 5% down under this new program. A 3-unit property is $1,123,900. That would be a purchase price max of roughly $183,000. So anything less than that, again, 5% down. And finally, a 4-unit property, $1,396,800 is the max loan amount, which would be a purchase price of $1,470,000. Okay, so these are the loan limits within the nation. If you have any questions about the loan limits in different areas of the country, of course, feel free to reach out to us. But we're going to jump into a couple other things here. Let's talk about the house hacking. So now, why do people house hack? Primarily, house hacking is done on multi-unit properties. They're not doing it on single families, unless, let's say, it has an accessory dwelling unit. I personally own one with an accessory dwelling unit. That allows me to rent that out, and that covers part of the mortgage. That would be house hacking. For a 2 to 4 unit property, you're going to be occupying one of the units, and then the other units are going to be rented. That's a method of house hacking because you're not paying for your entire mortgage. So again, the definition of house hacking is essentially leveraging a primary residence like an investment property. Now, what are the rules with this program? So you must live in one of the units if you're purchasing it as an owner-occupied home, for at least 1 year, okay? The other remaining units can help pay your mortgage, and once that 1 year is up, you can move out and you can have that other unit pay for your mortgage, or you can buy another property and do it again. You can sell anytime, so if 6 months after purchasing the home, you decide that you no longer want to own it, you can sell it. There's no hindrance, there's no prepayment penalties, there's no balloon payments on these loans. These are regular traditional home loans. Now that this sounds all great, what are the potential downfalls? Okay, so let's talk about that. Now, what are the downfalls of being a landlord or this program? If you're a landlord, you have a lot of responsibility. If a tenant destroys your property, you're the one responsible for making the repairs. You may be able to sue the tenant, but let's say the tenant does not have money, you're going to have a problem recouping the damage, and you've got to fix that in order to get it rentable. This is rare well, I don't like to say rare. It is rare enough to the point where it may not happen all the time, as long as you vet your tenants well. So I highly recommend doing that. Also, the remaining rents may not cover your entire mortgage in this market. So I would expect to having a housing obligation, but you're going to be owning your own home. Your rent will never be raised. You can of course raise other rents to help cover more of the mortgage, but yours will never increase. The principal and interest will never go up. One big thing to know is that multi-units are investor heavy. So if you're looking to make an offer on a multi-unit home, I would expect to have competition with investors, whether it's cash buyers, hard money, whatever it may be. These are properties that investors look to purchase. So you are going to be up against that when it comes to making offers on homes. It may start to get a little bit more aggressive in that realm than a single family home. So be prepared for that when making offers on a multifamily home. Another thing to know is that interest rates are higher on 2 to 4 unit properties than single family homes. It may not be a whole lot, but it's enough to make a difference in the monthly payment. So please contact us and we'll give you an idea of what your new monthly payment will be, and you can determine if the property that you're looking at is a wise investment. Another thing that can happen is vacancy loss. If a tenant moves out and you've got to make repairs to the home before renting it, then obviously you're losing out on that money for rent. So make sure to have reserves that can cover the mortgage, if you do have a vacancy loss scenario. So essentially there's all risks that we take as investors, but there are a lot more positives than negatives of owning your own piece of real estate. It is your bank. Every time you make a payment, your mortgage payment is going down. Unlike when you pay rent, that money is going nowhere. So at least look into this as being an opportunity, because it can provide an affordable way for you to get into a piece of real estate and actually own it with a minimal down payment. Now that you've heard all of this and have waited till the very end of the video, we do offer free consultations, so please call us. We can qualify you for a 2, 3, 4 unit property before this program releases on November 18th. So if you want to be one of the first people to take advantage of this program, reach out to us. Our contact information is all over this video, as well as our online application. Please make sure to do that, and then call any questions. And of course, if you like what you see here, we're always up to date on the new programs and guidelines, so please make sure to like, subscribe, and if you have any questions, comment on the video and we'll make sure to get back to you. Happy home hunting. Eric Sandstrom from the Home Loan Heroes, Senior Loan Officer with PrimeLending. Thanks so much.